Today on the Ask BP podcast, we're talking about which is better, an FHA loan or a conventional mortgage. Stay tuned.
You're listening to another BiggerPockets Ask BP podcast, where you'll hear short, direct answers to your biggest real estate questions. Submit your question today on Facebook, Twitter, or the BiggerPockets forums by using hashtag AskBP. And don't forget to pick up your copy of The Ultimate Beginner's Guide to Real Estate Investing and other great content when you sign up for your free account at BiggerPockets.com. With that, let's get to the show.
Hey, what is going on, everyone? My name is Brandon, and you are listening to the Ask BP podcast. Or maybe you're watching it if you're watching it on YouTube or on iTunes, or who knows. So the point is, you're here, and that's awesome, and we're going to have a lot of fun today talking about mortgages. Yes, I know that's a really exciting topic, but today is actually a very, very important question that a lot of people wonder about, and that is the topic of an FHA loan versus a conventional loan. There are two different types of mortgages, conventional and FHA. So we're going to dive into both those real quick. So the actual question comes from Matt from New York, and Matt asks, which is better, an FHA loan with PMI or a conventional mortgage with 20% down? Well, Matt, the simple answer is I don't know, because it's going to depend on a lot of things, but let me try to tell you the whole side of both stories, and you can decide what would work out best for you and for any of the listeners out there. And so first of all, let me explain what each are. An FHA loan is a government insured loan, which means that if you don't, if a bank issues an FHA loan, and let's say they loan it for, a $100,000 mortgage, and then I, the borrower, refuse to pay it, and I'm like, I ain't paying that, then the government's program, the FHA's program, will compensate the bank so that the bank doesn't lose as much money from not having to foreclose and that whole thing. So the government does this because they want to help more people afford mortgages. Now, why would that help them afford mortgages? Here's why. Because FHA allows for a lower down payment, as low as 3.5%. Used to be 5% back in the day, but now it's 3.5%. And you can get, actually, I think it used to be even 2% also. So you can get this loan for 3.5% through the FHA, and it's a little bit cheaper then, therefore, to buy a property. You don't need a full 20% down payment like a conventional loan. That's the other side of this equation. A conventional loan requires usually 20% down. Anytime you are buying a property with a mortgage and you put less than 20% down, there's a thing that kicks in called mortgage insurance, PMI, or in the case of FHA, they have their own name for it, MPI or MIP, I think is what it is. And so it's basically I don't know what you call it, the monthly payment that you have to pay the bank to cover the FHA. It's kind of like the payment for the insurance. So it's not like the government on the FHA loan. It's not that government's just being nice to you necessarily and giving you this low down payment. They're charging everybody that gets an FHA loan or any under 20% loan. The insurance companies are charging a fee for this ability to have a cheaper loan. And so it adds onto your payment. Now, this is not exact, but it's fairly good to estimate that every $100,000 that you finance for PMI is going to be about $100. Again, that's not exact, but it's pretty close. So if you had a $200,000 mortgage and you had to have PMI on it, it's probably going to be a couple $100 a month. There's a real just general rule of thumb, but that's about how much it costs. So as you can imagine, that would add quite a bit to your mortgage. So let's just say you bought that $200,000 property and you put 3.5% down. Not only is your payment higher than a conventional loan because you have a higher payment, because you didn't put as much down, like you have a higher balance, you also have this PMI. So let's use that example, $200,000. There's a property you want to buy and it's $200,000. Now, you could use an FHA loan, which is 3.5%, which 3.5% of $200,000 is $7,000. Am I thinking of that right? Yeah. So you got a $200,000 property and you put $7,000 down, meaning you've got a mortgage now for $193,000. Now you're going to have some closing costs too. So let's just round up. You're going to pay about $10,000 to buy that property. Now, if you were trying to buy the same property, the $200,000 property, but this time you wanted to go with a conventional 20% down payment loan. Now you're looking at 20% of $200,000 is $40,000 plus, let's say $3,000 for closing costs. So you've got $43,000 for conventional to buy it, and you've got $10,000 for an FHA. So you can see the difference. At least the FHA is much cheap, lower down payment. However, now you've got a conventional loan. On one hand, the conventional loan is for $160,000, right? Because we put $40,000 down. So we have a mortgage for $160,000. On the FHA, we have a mortgage for $193,000. So it's a much higher loan balance, therefore a higher monthly payment. And then you're going to add on the monthly PMI charge on top of that. So now not only do you have the higher payment, you get the PMI as well. And so in terms of which is better, the reason I can't say one versus the other is certain situations are going to be better or worse. And so what I like to see is, I think of like a rental. Now, FHA can't be used for rental properties, but it can be used for like a duplex or a triplex or a fourplex, as long as you plan on living in the property for a year. So let's just say you wanted to buy a property and it was $200,000 for a fourplex. And so you decided to buy it, and the numbers worked out so well that even with that added cost, even with the extra mortgage payment and the PMI and all that, it still cash flows really well. Maybe that's okay because it required less capital out of pocket. Now, maybe if you would have put down the conventional amount, yeah, you might get higher cash flow, but you had to put a lot more down. So what I'm driving at here is the idea of, if you're going to use one of the two, maybe look at your return on investment, especially if you're doing this house hacking idea of living in a duplex, triplex, or fourplex. You can kind of look at your return on investment, but you can do it with a single family house as well. What kind of return are you getting in one way versus another? Is it costly? Would you be better off saving that money and investing it in the stock market or in another rental property or in a hedge fund, or I don't know, whatever you want to do with your money? Do you have another use for the money? Matt, the guy who asked this question today, you said you had enough money for the down payment for the conventional loan. You have the $20,000 or, whatever it is. Let's say $40,000 in this case. You have the 20%. So is it better to do one or the other? I would say, unless you have a really good use for that extra money, it would be probably best to use the conventional, unless you had a better use for that money. I mean, what's the point of doing the 3.5% down payment if you're just going to stick all the extra money in your bank account to sit there? Now, yeah, you should have reserves, but you probably don't want that much money just sitting there when you could have it being used elsewhere. So again, if you have nowhere else to put it, it wouldn't be a bad idea to use it as a full 20% down payment on a property. And if not, you could go with the FHA and use that money. Now you're using a lot less. You might have an extra $30,000, let's say, to use for another property. Now you can get two deals versus just one. So again, see how it's hard to say one way or another, but depends on your goals. And so if it were me personally, I would probably do the FHA, take the extra money, and go buy another property with 20% down. And so that way I basically get two properties for the same amount as I would normally get one. So hopefully, Matt, that kind of makes sense to you and helps you kind of know which to choose, an FHA or a conventional loan. Before I get out of here, I do want to read today's success quote of the day. And that comes from good old Robert Kiyosaki, who said, "The size of your success is measured by the strength of your desire, the size of your dream, and how you handle disappointment along the way." And that comes from Cash Flow Quadrant, a great book. So pick that up if you haven't yet. Let's get out of here. Just remember, in your pursuit of your goals, dreams, and aspirations, don't just learn, but take action. And of course, one easy way to do that would be to go leave me a rating review. Go leave us a rating review in iTunes. Let iTunes know that you like this show. Really helps us out a lot. And of course, if you are watching this on YouTube, make sure you give us a thumbs up. We love that as well. With that, let's get out of here. For the Ask BP podcast, my name is Brandon Turner, and I am signing off.
You've just heard another episode of the BiggerPockets Ask BP podcast. Submit your question today on Facebook, Twitter, or the BiggerPockets forum by using hashtag AskBP. And for more incredible real estate investing tools and education, including a free download of our book, The Ultimate Beginner's Guide to Real Estate Investing, head over to BiggerPockets.com. and sign up for your free account today. We'll see you on the next show.